Thank you for taking the time to listen to our solution to the 2022 Rotman Sustainable Finance Case Competition. Our presentation will span 6 sections. We will first address what sustainable finance is. Then we will explain our objectives and constraints. Next, we'll describe the strategies we use to build our portfolio, after which we'll describe how we will achieve the endowment's return and risk objectives, as well as the approach to calculating or estimating net zero targets and positions of all investments recommended for the portfolio. My name is Yumi, and along with my colleagues Nikhil, Nick, Michael, and Kelly, we are the Triple Bottom Dimes. So what is sustainable finance? Sustainable investments are inclusive of investment approaches that consider environmental, social, and governance factors in portfolio selection and management across 7 strategies of sustainable or responsible investment. Sustainable investment has seen marked growth over the past decade. Societal and regulatory changes have forced investors' portfolios to evolve in response to climate-related risks and shifts in shareholder values that necessitate the inclusion of metrics beyond financial measures in portfolio selection and management. As of 2020, sustainable investment assets account for 35.9% of total assets under management, totaling $35.3 trillion, growing 15% from 2018 to 2020.
Now we will take a deeper dive into our main objective and the construction of our portfolio. We have developed a holistic approach to shift $1 billion of the $5 billion Canadian University Endowment Fund to a net zero position by 2032. The portfolio parameters and guidelines we will be following are broken down into 2 main categories, the first being financial. As it must be oriented towards capital protection, we have developed a long-term approach that is low risk and follows a return objective of 6.5% nominal per year. The portfolio provides net zero targets that align with your goals of seeing a full transition to net zero by 2032. As we take you through our approach, we will further break down our commitments, metrics, and composition plan. The portfolio should be consistent with all agreed upon policies and commitments. As a signatory of the Climate Charter and University Network for Investor Engagement, we must include an investing framework that is in line with the recognized standards and incorporates ESG factors into investment management practices. Our portfolio will be constructed with the exclusionary criteria and priorities that align with this policy. The Net Zero Commitment and NZAOA stipulates transitioning investment portfolios to net zero GHG emissions by 2050. With a net zero goal by 2032, our portfolio is on track to meet this goal well in advance. As well, we have established intermediate targets that will be measured annually. With our commitments and goals as a top priority, we have developed a strategy using 4 key approaches to sustainable investment. Overall, there are 7 core approaches to sustainable investment, and more recently, many investment strategies will use a combination of several sustainable approaches rather than just relying on one. Our approach includes a combination of negative and exclusionary screening, ESG integration, corporate engagement, and sustainability-themed investing. ESG integration incorporates explicit inclusion of environmental, social, and governance factors into the financial analysis. Sustainability-themed investing includes active investment in sustainable solutions such as sustainable agriculture or tech. Negative and exclusionary screening will include certain sectors or companies based on specific criteria that we will touch on later in this presentation. And lastly, corporate engagement and shareholder action includes employing shareholder power to influence corporate behavior through direct corporate engagement. I will now pass it over to Nick, who will provide more details on our portfolio priorities.
Thanks, Kelly. This chart shows the growth of the 4 sustainable investing strategies that we are going to be employing over the last 5 years. The creation of our portfolio incorporates each of these strategies through our exclusionary criteria and key priorities. Our exclusionary criteria is as follows. So number 1, all investments in our portfolio must be disclosing their emissions data, which is a form of ESG integration. The carbon emission metrics included in our annual benchmarking are as follows: Scope 1 and Scope 2 GHG emissions, total carbon emissions, weighted average carbon intensity, which is WACI. The omission of Scope 3 is because most firms do not report these emissions currently, And when they do, the amount is either highly incomplete or not fully reliable. The inclusion of scope 3 should be revisited in 2025 when more reliable disclosure or third-party data is available. As well, firms that are not voluntarily disclosing their data are less likely to be tracking or managing their emissions or do not publish it due to poor performance. Number 2, companies that have clearly defined goals to become carbon neutral by 2030 to 2040. The reason we included a buffer here beyond 2032 is to account for increasing adoption of new technology and economies of scale that could enable a subset of investments in our portfolio to reach their net zero goals sooner than expected. By engaging businesses with ambitious carbon goals rather than excluding them, we can take on more of an active stewardship role for these companies. Number 3, the board of directors must be made up of at least 60% independent advisors. Number 4, no material direct investment in fossil fuel companies, which is a form of exclusionary screening. And this is because this industry is the greatest source of carbon pollution. We do not view them as a viable long-term investment in the portfolio if it were to reach its stated goal of being net neutral by 2032. Overall, the portfolio will undergo a gradual carbon exposure reduction strategy by phasing out investments exposed to significant climate change risks or those that aren't advancing in their stated sustainability goals.
Okay, so now let's discuss how we'll measure progress towards these net zero goals. So we have the overall portfolio goals we want to achieve by 2032, as mentioned before, those being that the overall portfolio is completely net zero in scope 1 and 2 emissions, and that all companies in our portfolio will have at least 60% of their board of directors being independent. But to help make sure that we can achieve these goals, we've also created milestone goals for 2025, those being that we see a 30 to 40% reduction in scope 1 and 2 emissions across the portfolio, and that at least 75% of our portfolio has at least 60% of their board of directors being independent. If our portfolio can achieve these goals, we are confident that we'll be on track to achieving our 2032 goals, and it'll give a confidence in the makeup of our portfolio. Let's now talk about some of the risks that could prevent us from reaching our net zero goals. So 4 major risks we identified are: 1, shifts in government regulation or consumer preferences, which may affect how ambitious companies are with their net zero goals and how hard they pursue these goals. 2, whether companies in our portfolio continue to perform well in a low carbon environment, which will affect our returns and will make it easier or harder to justify a net zero portfolio. 3, the rapidly changing nature of climate science, which will affect the goals companies set, as well as how we measure carbon intensity. And 4, whether or not firms are actually meeting their stated ESG goals, which directly affects whether our portfolio can achieve our own net zero goals. So let's look at the formula we use to measure carbon intensity and how it can help mitigate some of these risks. We've chosen to measure carbon intensity in relation to the revenue of each issuer, weighted by how much our portfolio invests in that specific issuer, using the formula you see on screen. The benefits to this approach are that the measurement is more stable than just measuring carbon intensity on its own, and it reduces variability as emissions data improves by creating a strong baseline. It also allows us to use a standard metric across a variety of sectors and asset classes. And lastly, the revenues, or using revenues instead of market capitalization, provides a metric that is less susceptible to market fluctuations. So finally, let's discuss what happens if some of these risks are realized, a company is not on track to meet its net zero goals. The first thing we would do is investigate to determine the cause of the deviation to see if it can be quickly corrected. If this is not the case, then we would pursue active stewardship and work with the company to encourage a stronger commitment to getting back to its net zero goals. And lastly, if both of these steps fail, and as a last resort, we would divest from the company.
Now I'm going to talk about how we are going to manage this portfolio. Our portfolio will consist of 40% fixed income securities and 60% equities. Here's a breakdown of the fixed income section. By using a combination of government and corporate bonds, our portfolio will be really protected against those variations in stock prices and will provide the endowment with that stable return that it requires. So green bonds are products that we aim to focus on, and they finance renewable energy projects. They finance sustainable land use, clean transportation, and green buildings. The number of green bonds being used has been rapidly increasing since 2008, and governments and companies will need them in order to finance their transition away from these fossil fuels. Ontario is the largest issuer of Canadian green bonds, and we anticipate an increase in issuances as climate projects increase in scale. Ontario green bonds are highly rated, and based on the most recent issuances, have a spread of 64 basis points over similar maturities of Canadian government debt. We will purchase debt from provinces that have strong climate change policies because we believe that municipalities and provinces that don't take climate change seriously will have a real hard time financing their debt in the future. This is a similar strategy that BlackRock highlights in their fixed income investments. Other provinces such as Nova Scotia and British Columbia also have these similar offerings. So the debt portion of our portfolio will also consist of Canadian government bonds, and they have yields ranging between 1.4 and 2.1%. Also, we'll do Canadian corporate bonds. The main sectors that these bonds are in are communications, energy, financial services, and infrastructure and real estate. And many of the companies that issue the debt have 2050 net zero goals. So the ones that have 2050 net zero goals, we will purchase a shorter maturity debt. So by the time 2032 comes around, all of our debt in our portfolio will be this green bond. And this is very likely because there's an estimated $4 trillion of green bond issuances by 2025. So the equity portion of our portfolio consists of a sustainability themed investment section. And this focuses on companies that manufacture or produce renewable energy or other clean tech solutions. So the remainder of the portfolio is invested in companies that have passed our aforementioned elimination and exclusionary criteria. So just to reiterate those, we will only invest in companies that actively measure and monitor their greenhouse gas emissions. We will only invest in companies that really do have those clear net zero goals. And we will not invest in companies in those high emitting sectors. And the board of directors must be 60% independent. So using Bloomberg to filter out companies that meet our selected criteria, we are left with many companies with really strong earnings potentials. Since our portfolio has a net zero by 2032 target, we must subsidize the greenhouse gas emissions of post-2032 greenhouse gas emitting companies through investing in these sustainability themed companies. So how is that going to look like? So this is an example of the method that we'd use, and it just is a very similar breakdown of what we're kind of going to do with a company like BMW, who has that 2050 net zero goal. So we model their greenhouse gas emissions based on the information that we have available and the ones that they've released. So this is why they must be companies that really release those greenhouse gas scope 1 and scope 2. And then we invest in those and we subsidize the amount over $0. And we subsidize it by investing in companies like Brookfield Renewable or carbon capturing companies that same portion of greenhouse gas emissions. So here's a breakdown of the sectors that we will be investing the endowment in. Other endowments funds have pledged to be fully off fossil fuel investments by 2025. But since we are starting in 2022, we really do have this unique opportunity to invest in low emitting sectors and avoid fossil fuels and mining companies altogether. Historic performance is not an indicator of future success. And although these were high performing sectors in the stock market, a shift is coming. From analyzing the performance of a random basket of 30 stocks that have aligned with this sector breakdown and match our exclusionary criteria, we were able to see a slight underperformance versus the traditional S&P 500 and amounted to only 9.6% return annually. These 30 companies is a subset of our overarching portfolio and is going to be a really strong indicator of how we anticipate that our portfolio will perform. These are good companies that have these net zero goals, including Microsoft, Accenture, BlackRock, RBC, 3M, First Solar, and more. Our expectation is that as more institutional investors are integrating ESG analysis in their portfolio, lower emitting sectors and companies with clearly defined GHG goals will strongly perform the market and begin to outperform these older laggard companies in the S&P. We believe that companies with little regard for climate change are actually inherently more risky because they will respond in regulation in a more ad hoc manner and fail to be sustainable investments in the long term. So this portfolio that I've outlined will reach your endowment's objectives in protecting your capital and reaching that 6.6% expected return and net zero by 2032.
We recognize that making a net zero transition is not without its challenges. Transition risk is that associated with shifting towards a sustainable economy. This transition means that stronger regulations, increased liability, and technical progress, as well as shifts in stakeholder expectations, may challenge how businesses are operated and valuated. However, our investment strategy helps mitigate this transition risk throughout both the portfolio selection and management stages. ESG integration protects us from reputational risk and ensures that we are investing in companies that align with shareholder values. Negative screening means our early stage low carbon portfolio mitigates risks associated with stranded asset repricing, increased regulation and cost, and changing consumer preferences. Forward-looking data allows us to predict whether companies are positioned to thrive in a low carbon economy and invest accordingly. Investing in sustainable solutions means benefiting from technological advancement rather than being disrupted by it. Thank you for listening to our presentation.